Was my real estate startup a scam? That's a question that people have, and today we have the answer. The first two times that we fundraised, we had no operations. We just had an idea. Well, as of today, we've been operating for 175 days. We generated approximately over $4 million in gross profits. That's about $22.8 thousand per day. And just $24 million of real estate. That's because we haven't even fully deployed the capital that we have invested in the company yet. Now the question is, should we stop with the real estate that we have acquired and the value we have created? Or do we keep going? In this video, you're going to see the vision. We're going to show you how not only are we opening up the opportunity to be a part of this real estate investment again, but we're showing you the path forward, the path for how we can turn this into multiple cycles rather than just a one-off. Keep in mind, even if we were to stop today and we completed just one mini fund cycle with our company, we'd be net profitable. And we've only been operating for 175 days. In this video, you're going to learn a lot more. This morning, somebody came to me and said, Kevin, what's HouseHack? That was on our Market Open live stream. And I'm like, wow, I think I need to remind everybody that I have a real estate startup, and officially starting today, we are fundraising from accredited investors. And now we'll explain what all of that means. But first, I think it's worth you knowing what the heck HouseHack does. And quite frankly, even if you're not interested in being an investor, you're going to learn a lot in this video about how the real estate investing world works. So that way you can be a little bit more aware when you're looking at real estate investments, how you want to diversify your money. So we'll talk about a lot. Let's get right into it. So what is HouseHack? Briefly, HouseHack is a company that makes money from buying fixer-uppers, distressed properties, foreclosures, or otherwise mismanaged houses or apartment buildings. We then renovate them, add value, add accessory dwelling units, we improve the management, and we fully rent out the properties. We do all the property management in-house and the renovations. Obviously, we work with our own contractors in-house or outsource. Then, once the properties are rented out, we call that being stabilized, we bundle the properties up and we sell slices to institutions or on exchange, or people who want to defer taxes and maybe invest in our mini funds, little pies of real estate, so to speak, through a 1031 exchange, which we'll talk about those details in the future. But the point is, our company makes more money the better deals we get. Basically, the cheaper we can get the ingredients means we can make more money because we're going to sell those properties as pies for fair market value. And that'll be independently verified. We're not trying to make money by selling properties for more than they're worth. We just buy them for a lot less than they're worth, stabilize them, and basically roll them. Now, the difference between this and flipping is we retain management, and we're making sure that these pies are stable for the long term. It's not like we're trying to just get rid of these properties. We're still involved for the long term. And what I found is that as a licensed real estate broker, former licensed contractor, a mortgage loan originator, currently licensed FINRA Series 7, 24, 27, 14, 63, and 65, I get finance. And one of the biggest things that I've learned over the last 14 years of doing this is real estate agents dislike Wall Street finance folks, and Wall Street finance folks dislike real estate folks. This is possibly because of the way people are compensated. Real estate agents make money through commissions and selling houses. Fund managers make money by allocating money to funds. And so fund managers don't make money if somebody takes that money and invests it into real estate directly. Real estate agents make money. Real estate agents don't make money if somebody takes their money and throws it into a fund, right? So you've got a little bit of this tension between these industries. In my opinion, that tension has created massively huge missed profitability opportunities, both for investors and, quite frankly, companies like HouseHack. At HouseHack, we want to take that money and basically make a lot of money for our investors and, of course, our company, our employees, our team, the people working with the company. That's the point. That's the point of capitalism, to find an inefficiency and then solve the inefficiency, providing value to customers and making money. So how do we do that? Well, first, we got to stop doing what everybody else has done and struggled with. So let's think about that for a moment. In real estate, there are a few ways you can make money. You can buy real estate yourself. This is great, and I actually encourage people buy real estate. I think this is great. It just comes with headaches, and it's not right for everyone. Acquiring real estate, it doesn't give you diversification unless you can really manage properties in multiple different areas. You have to work with agents and lenders, renovate the real estate, and work with contractors, deal with city permits, deal with the challenges that come with renting real estate, dealing with property managers or doing that yourself and learning property management, dealing with tenants and repairs and quite frankly, tenants and toilets and delinquencies, or hopefully not delinquencies. But the point is, that's a lot to do. Or you could buy a property and then just quickly flip it for a profit, but you also have a lot of selling costs that can eat away at your profits, often 7 to 10%. Sure, you could represent yourself as an agent and try to save some money, but let's be real. Most people end up spending 4 to 6% on commissions, 1% on escrow title fees, another 3 to 4% on repairs during escrow. That's typical of almost every transaction that I've done with clients. It's just very normal. Now, again, you don't have to flip. You could hold on to the properties and manage them yourself. And then the goal is to refinance, but rates have to be appropriate and you're still dealing with lenders and qualifying. So there's still work involved. This doesn't even mention finding a good deal and actually negotiating a good deal and valuing the real estate correctly. It's a pain in the butt. I know, I do it every day. I just happen to like it. Now, option number 3 is you can invest in some kind of fund. The problem though with funds is they're often bloated with expensive acquisition fees, platform fees, disposition fees, renovation fees, asset management fees, annual fees to basically manage the manager. Add to that waterfalls like 20 to sometimes 35% of your appreciation going away. Buy a $100,000 property, it's worth $200,000 in the future. Let's say there's $100,000 of gains. Well, you might have to give away up to 35% of that to the promoter of the fund in a syndication or a partnership. And then you have to deal with the K-1 on your tax return, which is a pain in the butt. It's not that straightforward. It all creates work and effort and, quite frankly, lots of fees. The other option is maybe you invest in a REIT or a DST, but you have to be careful about bloated book values and fees here too. Look at Invitation Homes or American Homes for Rent. You're paying $2 to $2.30, sometimes even more, per $1 of real estate they have on their books. That's because REITs often sell for 2 times book value. On top of that, with American Homes, and specifically, you're spending another about 11.8% of your rent on operating expenses, plus another property expenses line, which presumably includes things like taxes, insurance, utilities, reserves, whatever. But who knows what other kind of OPEX is in there? It's not broken out. At least I couldn't quickly find it. And obviously verify this yourself. This video is not to bag on other opportunities. It's just to say, it's complicated. The choices aren't that easy. And we think that creates an opportunity for us. Now, I'll explain that. But first, you might be then thinking to yourself, well, what about like Vanguard, like a Vanguard real estate fund? Sure. But what does Vanguard do? Well, Vanguard charges you a fee to allocate you to different home builders and REITs. So you get the same problem with just the Vanguard fee on top. Okay, well, what about like Fundrise or Roofstock or Arrived Homes? Okay, well, let's think about those. So Roofstock, they tell you their advisory fee is 15 basis points, so 0.15, but then they sneak in another 0.85% for management, and then they suggest additional renovation and distribution fees. You got to read their documents yourself, obviously, but these are things to consider. Then there's Arrived Homes. Let's just look at some of the Arrived Homes documents to look at their latest filing. This was on like a $7.8 million offering they did. So we pay our manager 2% of the gross proceeds. Okay, got it. So if you raise, let's just make the math easy. If you raise $8 million, 2% is $160,000 going to the manager. Okay, maybe that's not that bad. But then they charge another 2% if you sell your shares within the first 6 to 12 months. So that doubles that to potentially $320,000, presuming everybody were to sell within 6 to 12 months. But maybe you don't do that and they waive the redemption fee over time, fine. But take a look at some of these other ones. What fees and expenses do you pay your manager or any of its affiliates? Reimbursements of offering, acquisition origination fees, asset management fees, broker fees, financing fees, other operating expenses, property management fees, special servicing expenses, auditing, valuation fees, asset disposition fees. That's a lot. But wait, are some of these actually broken down? Oh, yes. Yes, indeed, they are. So here's the 2% of gross offering proceeds for out-of-pocket expenses for the manager receiving that, okay? But then wait a minute, what's this? With respect to our equity investments, we will pay up to 3.5% of the total purchase price for any property in which we make an equity investment. In other words, the fund is going to, as a sponsor fee, all of these sourcing fees will be paid to our sponsor, will pay somewhere between 2.5% to 3.5% on top of the manager fee as a sponsor fee to the fund manager. Okay, wait, so it feels like we're paying the manager twice here, but okay, this is their form. Maybe I'm just misunderstanding it. But then they're also going to charge a quarterly asset management fee annualized to the rate of 1%. And it doesn't even end there, because then they're going to pay a disposition fee of 6% of the gross proceeds. The manager will be entitled to retain the difference between fees paid to the broker and the 6% charged to the company. So in other words, if they're their own broker, they're just purposely trying to keep their own 6% as a liquidation fee. Or what they're more likely to do is pay a lower commission to their agents. So let's say they pay a total of a 3% commission, 1.5 and 1.5, because they're selling a portfolio and they're negotiating a deal there. They're basically charging a 3% liquidation fee. Ouch. I just want to be very clear about this, is that's what's out there. And so at HouseHack, we're looking at this going, this is ridiculous. I'm not here to bag on any one company because they're all doing it. They're all doing this with the fees, and it's nuts. So what does HouseHack do? How does HouseHack make money, and how is HouseHack different? It's very simple. HouseHack makes money by buying great deals and doing a great job managing them. Hopefully we'll manage these properties forever. We're not trying to turn real estate and constantly sell it in our mini funds over. It's not what we're trying to do, because we don't make money on acquisition or disposition. We make money by getting a good deal. HouseHack buys a good deal, and then we roll it to our mini funds and we manage it ideally forever. That way we have stable assets and we make money on the difference. We manage our stuff in-house so we can scale our own team, control quality, and minimize costs. So let me give you an example on how this works. If, let's say, we buy a house, which we did, and we're all in on it for $500,000. Here's an example of one. We're all in for $500,000. The fair market value is $600,000. So we sell it as part of a bundle for $600,000. So we're not selling it for more than market value. We just got a good deal on it. Now, obviously, if we got a bad deal, we'd still be selling it for $600K. We just take a loss. That's a risk, right? But our goal is to buy properties for less than they're worth. Here's a building we bought for $15.7 million. It was mismanaged. We believe the debt was coming due, so there was a lot of pressure, and we negotiated what we think is a win-win deal. The sellers got a cash deal. They're great people. They did a great job on their development, but the market is what the market is. And so we think we got a deal for $15.7 million that, once stabilized and managed the way we manage buildings, could probably sell for $18 million. Okay, well, that's $2.3 million in what we call the wedge. That's how HouseHack makes money. The more we can do the wedges, the better. Let me phrase that a little bit differently. Think about mini funds. So we buy homes, we stabilize them, we rent them out. Think about mini funds as like little pies. We buy all the ingredients, that's getting everything ready. And then we roll that pie or sell it to a mini fund, which we manage. And somebody can buy little slices of the pie. So you get a delicious pie that offers you no fees, diversification, predictable cash flow, appreciation, because the people who own the pies get appreciation, diversification, cash flow, the benefits of no fees, asset management fees, disposition fees, whatever, renovation fees, all that nonsense. We're not charging all that crap. That's what we're doing. We're creating what we think is a really good product. We're creating the pie. HouseHack is the pie maker. We make the pie. And then our job is to sell the pie. We make the pie, we sell the pie. It's simple. If we can get the pie ingredients really cheaply, we make more money. That's how HouseHack makes money. And again, that's because we're negotiating really good deals. That's hard for people to do, but we think we can do it at scale. Obviously, there's risk in all of this. None of this could work out at scale. The first time we fundraised, all of this was an idea. We weren't operating. Today we're operating. We've got 12 excellent employees. We're doing a phenomenal job, in my opinion. But I'm biased. So you have to conduct your own due diligence, read our prospectus, understand the risks. But consider this. So we get pie ingredients at a really, really good negotiated rate. We're not flipping on the markets. We're not paying crazy selling costs. We're actually retaining management of these buildings. So we're vested in the long-term quality of what we're buying because we got to manage it. So we think we're putting together a really delicious pie and people can buy slices of this pie. Now, who would buy slices of the pie? Well, it's simple. Potentially anybody who just wants to swipe up on Robinhood and diversify into real estate through a publicly listed entity. Or somebody who wants to 1031. Imagine you own 3 rental properties and you're like, I'm done. I just want to diversify. I want to defer taxes. I'm going to sell my portfolio and I've got $2 million. But if I touch that money, I have to pay, say, 40% in taxes. So all of a sudden you're down to $1.2 million. Well, that sucks. Well, what if you could take that $2 million and put it into one of our mini funds, which you can email us at ir@househack.com. Now what happens? Well, you have the full $2 million in there and you're deferring taxes. Now, obviously talk to your CPA, but see, we're creating a really delicious pie for people with a need. People with a need who want to diversify on the public market, people who want to 1031 into this delicious pie, family offices, banks, Goldman Sachs, Morgan Stanley, JP Morgan. We have a relationship with JP Morgan, wealth managers, hedge funds, pension funds, you name it. So mini funds, they're not just going to be one entity. We'll have many different flavors of these pies for people to invest in. And since we don't charge a fee on our pie, maybe wealth managers add their own fee to it and sell it to their clients. I don't know. That's an option. But again, we're not charging fees on those pies because we just want delicious pies that people love, like In-N-Out, right? The price is right and it's great quality. That's simple. And so where do we make the money? Again, buying the ingredients cheaply. And then we sell for fair market value based on valuations of what other things are selling for in the neighborhood. That's simple. And so again, we buy wedge deals, we buy the ingredients inexpensively, and we sell delicious pie. That's our company. The more pie we can sell and the more earnings per share we could generate, the greater the valuation for HouseHack. HouseHack is the company that does the management, the acquisition, the negotiation, the renovations. HouseHack deals with all the headache. So HouseHack is a service business that makes money and will probably be valued based on how well it handles all of these pain points in real estate. We are also buying assets where we think there's little competition. You know, we play a bigger game than mom and pops, but we're not as big as a Blackstone that's going for, a $500 or $1 billion skyscraper, $500 million to $1 billion skyscraper, right? So we think the opportunities are really endless for us and timing, frankly, couldn't be better. Multifamily loan defaults just skyrocketed. Per the Wall Street Journal, we went from 0.4% defaults in multifamily in January 2023 to 9%. That means almost 1 out of every 10 multifamily buildings is in default. That is an over 22% increase. 1 in 3 multifamily loans, approximately, are late on their loan. Yeah. See the opportunity? Delicious. So again, that's what HouseHack is. And how can you invest? Well, you have to be an accredited investor. The minimum investment amount is $40,000. And if you invest $100,000, you get warrants. The warrants will be available it's for call, so that's when they're due, as early as 2026, which is nice because it basically gives you at minimum 18 months, where you could decide in 18 months if you want to invest more. But if you invest 100K, you get 50% of your investment in warrants. So if you invest 100K, you'd get $50,000 in value in warrants at the current share price to buy more shares 18 months down the road or more. And you don't have to, it's sort of a free option. But the minimum investment is $40,000. And if you invest $100,000, you get warrants. It's very simple. The share price is $2 per share. Also, very simple. Now, it's important to remember what an accredited investor is and that this is a Regulation D offering, which means it's only available to accredited investors. We had a non-accredited round last year. If you didn't invest in the non-accredited round, maybe there'll be another one in the future, but I can't guarantee that at this point. When I talk Regulation D, it's very important that you remember this means there's a PPM. Private Placement Memorandum. This is called a prospectus, basically. It's important to read the risk factors. Remember, I've just gone through problems in real estate. I've gone through how we think we can solve them. But you have to remember, even though I have a background in real estate, we haven't done mini funds before. We are in talks with wealth managers who are like, this is a great idea. Please bring us these products. We're in talk with the NASDAQ, New York Stock Exchange, whatever. These are all great things, but none of those guarantee that the company will be a success. In fact, if you invest in the company, you could lose all your money. That's the nature of a startup investment. This is a startup. So I want to be very clear. And anything we're talking about here can change and evolve. When we started this company, we made it very clear that our goal is to acquire real estate and then strategically and opportunistically sell that real estate. But we hadn't fully formulated yet exactly how we're going to do that. Now, we think not only do we have the vision, but we've got the operation already in the works on acquisitions, rentals, property management, renovations. This is going great. And we're in a position where we think we're getting pretty close to launching our first mini fund, which could be a publicly listed entity. But then again, that might be subject to investment bankers, or maybe a private fund is like, Kevin, don't forget doing that. Give us that product. We want that product so we can put our fee on it. Who knows? I don't know. There are so many things that are unknown. I just want to be very clear. Please, please, please read the PPM. Understand the risks involved in investing in this company. So that way, when you hear me say, hey, these shares are selling for $2, and I think, my goal, and I'm hanging my reputation on the success of this company, is to grow these shares to $10, $20 per share or more. I can't promise or guarantee that. I'm not even calling it a projection. That's my hope. It's my vision. I think so far we've been executing phenomenally well, but always remember, investing in startups is risky. So read that PPM very carefully. It's not something where I could give you a summary of it either, because legally you're supposed to read all of it. So just keep that in mind. I can't even highlight it for you. Everybody always liked when I used to go through bills and I highlight things. And the SEC is like, you can't highlight any of it. I'm like, really? Make it easier for people. You gotta read the doc. So anyway, keep that in mind. The deadline of this offer is expected to be June 30th, 2024. So while we could close the offering early, it's probably going to be June 30th, 2024. You can always email us with questions at ir@househack.com. Make sure to click the link down below to go to househack.investready.com to get your Invest Ready letter. Remember, you have to be an accredited investor to invest. I'll explain that in a moment. Today, we have about 30 stabilized units. We're about $29 million in, and that does include a chunk that are in construction. So obviously, our average cost per door is going to be way lower. And we're trying to get to about 100 doors here before we do our first pie, so to speak. There are plenty of other updates on this channel that you could watch. I think it's very important to stay tuned to this channel or our Twitter channel where we post these videos and updates. Also worth noting that we're in 2 states right now, a little more than 5 different cities. By the way, more of this information and spreadsheets will be found at househack.com. Just click the investor tab or the link below. But remember, to be an accredited investor, the easiest thing to do is go to househack.investready.com and get a letter from them. You'll have to show them your W-2s, your tax returns, or something to prove that you're an accredited investor. About 18% of people are accredited investors today, and it looks like the SEC is probably going to start changing the accredited investor rules. So pay attention to that. I think they're doing that in April. I'm not sure, but it's possible that they'll reduce the amount of accredited investors from like 18% of households to like 5 or 10%. Which means the income criteria will go up. It'll be harder to be an accredited investor. Currently, you have to, as an individual, make $200,000 or $300,000 as a couple. The other option is having a Series 7, 65, or 82 license, being a family client of a family office, or having a net worth of over $1 million outside of your primary residence. Now, again, go to househack.investready.com to get your letter and then sign up and follow the steps at househack.com after reading the PPM. Well, there you go. Our fundraise is live. Thank you so much for watching, and see you in the next one. Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is neither personalized financial nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF and hold long positions in various securities mentioned, including potential short positions. However, I have no relationship to any issuers, nor am I presently acting as a market maker.